All right, hi everybody. Welcome back to the channel. And today I thought we would discuss an interesting topic that is gold passive income. Now, one of the main problems with gold and silver, and we're also going to discuss this from the context of silver, but one of the main problems with these precious metals is that yes, gold and silver have been used for thousands of years as a store of value by many people around the globe. Whether it's the Egyptians, whether it's the going back to the Romans. I think they started diluting silver coins, if I'm not mistaken, back in Roman times. But, going back to Jesus, pulling the gold coin out of the fish's mouth, right? So we have all of this kind of stuff where investing in gold and silver has always kind of been this, it has a certain aura about it, right? People get excited. People get very passionate about this. But the problem is with investing in gold and silver is that the passive income is just not there. And one thing I love to talk about on this channel is how to earn cash flow. Because the reality is we live in a system that requires us, if we want to be able to have financial freedom, to get cash flow from our investments. And so in this video, I wanted to discuss 3 ways you can earn this passive income. Now, the first way, as you'll see, is investing in gold and silver royalty companies. So here's some of the pros and cons, and I will leave this article below. So when it comes to investing in gold royalties, the benefit is passive income generation, as this article says. It offers several advantages that makes it appealing to investors. So it's potential for high returns. And the royalty companies benefit from the success of multiple mining operations. So we have diversification benefits, as that paragraph says. But scrolling down, we have some key takeaways here in terms of investing in gold and silver royalty companies for potential high returns, diversification, passive income. But the cons include volatility and risk, mining operations, control over operations, or limited control because you're only a part owner. Kind of like with any dividend stock or ETF or whatever it is, you're going to be a part owner if you're investing in a Vanguard ETF, for example. But you also have economic factors, market forces, etc. And it kind of goes on. So it's actually a pretty lengthy article, but the point is, what this basically is you have these deals set up between gold and silver mining companies where they will get income from the mining operations, kind of like a royalty stream. If you think about Kevin O'Leary on Shark Tank, that's kind of a good way to think of it. You're investing in a mining operation and you're getting back part of the income that the mine itself is generating. So it's basically a way to invest in like a gold mining company. And that is my next discussion, actually, is how do we earn passive income directly from stocks like Newmont Mining. We have B2 Gold Corp as well, is another great gold mining stock. And this one in particular is down, right? So if you look at the dividends, though, this dividend is very consistent. And that's what I love about this company. I've definitely discussed this on the channel before. But, with gold hitting 2,500, the sentiment for gold is very bullish right now, I think, by a lot of people. And so people might be looking to capitalize on the gold and silver market. But, like I said, one thing I like to talk about is how do we get exposure to the gold and silver market? Sure, but then how do we also turn that into yield? So in this regard, we have these monthly, they're quarterly dividends. So I talk a lot about monthly dividends on the channel, so subscribe if you want to see content like that. But these are quarterly dividends every 3 months. As you'll see, very consistent, 4 cents a share. And you're going to be getting those dividends nonstop. If you look back at the last several years, people who love consistency, since 2020, they've paid out a consistent 4 cents per share, which comes up to a 6.48% dividend yield. Now, with that being said, just remember that with these companies, they can always cut dividends. And that brings me to my next company here, Newmont Mining. Another good company, but look at this. They actually raised their dividend back in 2019 to 25 cents from 14 cents. Paying every 3 months, then to 40 cents, then to 55 cents. So in this case, you're getting every 3 months this paid out per share. And the way you invest in these companies is just like any other stock. That's the beauty of it. So this is my second way of earning passive income from the gold and silver market, is simply to invest in these companies. But if you look at the dividend itself, we have a 40-cent dividend cut from 55, then down to 25 cents. And so then it becomes a question of what's going on with the business behind the scenes. Because with any dividend stock, you have a business behind it. You can look at the face value and say, oh, it's paying out this much in dividends. But with that being said, you have an operation. Even with these ETFs, you have an operation, you have traders, you have the fund. What if it shuts down? In the case of these mines, what if these mines shut down and Newmont Mining is not as strong as it once was? And so why are they cutting their dividend? That's kind of a deep dive situation. But the point is, there's lots of companies out here that are investing, mining stocks, large international stocks like Newmont Mining. Because let's face it, in terms of market cap, right, one of the largest is going to be Newmont Mining. And so this is a dividend stock that's been paying for several years, even though they've cut the dividend. The share price is also down from where it was. Then you have companies like Rio Tinto, right? So Rio Tinto is another one I've discussed on the channel. And this company right now, I want to say, is paying 7 or 9%. I could look at the exact dividends. But if we look at, for example, the last 5 years, nice sideways trading pattern. I would say this one's, with a lot of these mining stocks, you're not going to have a ton of volatility, I would say. But if you look at the dividend itself, we're paying out 6.88%, so almost 7% on this yield as well. And this is another mining company, right? They do mine gold and silver, but copper is primary on this one as well. So just another example of a dividend stock that you could potentially use as an investor to earn regular passive income. So that's my second way of earning from the gold and silver market, regular income. So we have gold royalties and then investing directly into companies by opening a brokerage account and investing in these stocks. The third way, and this may be my favorite way. Now, there's some people who say the SPDR Gold Trust is not up to par because of the fact that they have clauses where basically the gold may not be guaranteed and stuff like that. Nonetheless, it still tries to track the price of gold. So we have ETFs like the SPDR Gold Trust, and we also have the wheel strategy. Now, if we look at the gold market, and let's say you own shares of the SPDR Gold Trust, you could actually enter in to a covered call trade. And I saw what's called an exchange traded note by, I think it was Credit Suisse, that came out several years ago. It was GLDI. And what they did is they actually did a covered call strategy against the SPDR Gold Shares ETF. And in this case, you are limiting your upside. So if you're doing a covered call trade, let's say at 230, and we could also switch back to cash secured puts and etc. But let's say a covered call trade, we're going to sell to open, and let's say we own 1,000 shares of this ETF. So if you own 1,000 shares of the SPDR Gold Trust, you actually, let's find out how much we have. 224 times 56 is going to be $224,000 in this ETF. So this assumes you have a fairly large portfolio bucket, whatever you want to call it, in terms of how much you have in this ETF. But if you had 1,000 shares at $224 a share, you could enter into 10 contracts. And these 10 contracts on the call side, if we're selling, let's say, a 230 strike option, and we want to earn, let's say, a monthly income from this, we could essentially say we're going to sell this covered call, which gives the buyer of the option the right, but not the obligation to assign it to us, or we would basically have to sell our shares at 230. So what that means is if we enter the strike price of 230 here and we go out, today's August 10th, let's go out to September 13th. So just a little bit more than a month out. And you can see the bid and the ask price here for a $230 strike option is $2.84. Now, if we look at this, what we're doing is we're actually generating over $2,833 for this call option. And the reason we're getting this is to compensate for the risk that GLD will rise above 230 by the expiration day. Because in that case, the buyer of the call option, right? So for every call option and put option, there's a buyer and a seller. But the buyer of the put option will benefit anything above 230. So if the GLD goes to 250, the buyer of the call option is going to be very happy. I'm going to be sad, though, because I missed out on all the upside because I'm forced to sell my 1,000 shares at 230. Nonetheless, we're still generating $2,800 in passive income with 1,000 shares. Now, if we go, I say passive, but you have to have the money up front, obviously, to do this, which in this case, not everybody has $200,000 laying around, myself included, right? But you could even do it with just 500 shares. That's about $100,000. Or let's say, if you had a diversified portfolio that's worth $100,000 total, you could have $10,000 put in, or I'm sorry, it'd have to be a minimum of $20,000 because each options contract is 100 shares. So always keep that in mind. But in terms of the puts, right? So we could switch over to the put side. This is known as the wheel strategy, where we kind of rotate everything out, and we do this on a consistent basis. We have, let's say, a put of 220, so we're agreeing to buy the GLD at a discount of $220 per share. And what we're doing here is selling to open even just one contract. It would take about 25,000, or actually, I'm sorry, 200. It would take $22,000 exactly, because the strike price is 220. We're only selling one contract in this case, which is 100 shares. And what that means is you simply multiply 220 times 100 shares in this case, which is the strike price. And in this case, we're putting up $22,000 for this trade. Now, you look at the number here. If we're getting a bid price of $2 per share, we have $200 total just from that trade. Now, if we did have 1,000 shares, now you're talking roughly $2,000 for this trade. So it gives you an idea based upon different dollar amounts of how you could go about participating maybe in some of the upside of the gold market or the silver market. The other one would be SLV, by the way. So if you want to do this against SLV, which is the ETF that is tracking the iShares Silver Trust, they also have a liquid options market. And you can take a look at what they have in terms of, the main benefit of this is that you only need, let's say, $2,500 to do one options contract in this case, because the share price is cheaper, right? So $25 times 100 shares, and you can do the wheel strategy, covered calls, and all that kind of stuff with only 100 shares. Now, I know I'm kind of going off on a tangent and explaining a lot with this, but the point is you can use gold and silver ETFs and extract income from the movements, and hopefully you don't get assigned, right? Best case scenario, you can ride this out, let's say 7 or 8 out of 10 times in a row to where you don't get called away, or you're not forced to buy after the share price has gone down. So that's known as the wheel strategy. I will leave a link as well in the description about the wheel strategy if you want to learn more. But with that being said, these are my 3 ways of earning passive income with the gold and silver market, especially with gold going up. They're saying it could hit $3,000 an ounce. It absolutely could. And what we're seeing here is, we can invest directly in dividend stocks, and you can also do covered calls and cash secured puts against individual stocks as well. Keep that in mind. But we also have, not only the individual stocks, we have the ETFs. We can go ahead and try to extract the wheel strategy, cash secured puts, covered calls. And then the first thing we talked about was the gold royalties, right? So gold royalties, they have these mining operations. Think about Kevin O'Leary. Think about how he invests in companies, he invests in products, but he wants a royalty in exchange, right? So with that being said, these gold companies, they want their royalties. They pay that out to you as a part owner in these gold royalties from these mining operations. So it's kind of a more indirect way of investing, let's say, directly into a Newmont Mining, where they're, earning a profit, right? And they're paying that out in terms of dividends. Or, the other example, which honestly, the dividends in this are a lot more stable. B2 Gold, once again, 4 cents a share. You're getting that every 3 months, and they have not cut their dividend. So with that being said, thank you so much for tuning into this video. I hope this kind of gave you some insights, because like I said, one of the main problems is that the gold and silver market, they are just like a nice rock. But if you don't have passive income, then you're not going to be able to earn anything on that, right? So how do you get cash flow? How do you get the passive income? How do you get to the point where you can start regularly making the income for your portfolio from gold and silver? So with that being said, guys, thank you so much for tuning in once again. God bless, and we will see you in the next one.